If you are nearing retirement or already semi-retired and picking up consulting gigs, freelance work, or running a small side business, you might be asking yourself a critical question: how can I protect my hard-earned income from taxes while boosting my retirement nest egg as quickly as possible? Many people assuming retirement means they can no longer save in a formal workplace plan are surprised to learn about one of the most powerful wealth-building and tax-saving tools available in the tax code, the solo 401k. As you approach your late 50s or 60s, a major fear is running out of money or watching a significant chunk of your side hustle income disappear to federal and state taxes. Standard IRAs have strict limits. For people age 50 and older, traditional or Roth IRAs cap your contributions at under $10,000 a year. That simply does not leave much room to make a meaningful dent in your taxable income if you are earning solid 1099 income as a high-fee consultant or sole proprietor. You might worry that setting up a corporate retirement plan requires an army of accountants, expensive administration fees, or complicated compliance paperwork. The reality is that a solo 401k, also known as an individual 401k or one-participant 401k, is designed specifically for people in your exact position. It gives you all the muscle of a Fortune 500 corporate 401k, but tailored for a business with only one employee, you. To qualify for a solo 401k, you only need to satisfy two basic requirements. First, you must have self-employment earned income. This can come from a sole proprietorship, an LLC, an S corporation, or simply 1099 income from consulting, coaching, selling online, or freelance work. Second, your business must have no full-time W-2 employees other than yourself and, if applicable, your spouse. If you hire independent contractors or temporary help under 1,000 hours a year, you still qualify. What makes the solo 401k extraordinarily potent for pre-retirees and retirees is the double-dipping rule. Because you are the business owner, the IRS allows you to wear two distinct hats, the employee and the employer. This means you can make contributions under both roles from the exact same self-employment income stream. First, let us look at your role as the employee. You can make an elective deferral of up to 100% of your earned income up to the standard annual employee limit. If you are age 50 or older, you unlock significant catch-up contributions. If you are between ages 60 and 63, recent tax law updates under the Secure 2.0 Act grant an even higher super catch-up limit. Combining your base employee deferral with these catch-up provisions allows you to shelter well over $30,000 per year purely through employee contributions. Second, you change hats and act as the employer. As the employer, you can make a profit-sharing contribution to your own plan. Depending on how your business is structured, whether as a sole proprietorship, LLC, or S corporation, your business can contribute up to 20 to 25% of your net self-employment income. When you combine both the employee deferral and the employer profit-sharing contribution, the total amount you can stash away into a solo 401k can easily reach upwards of $70,000 or more in a single tax year. Compare that to a traditional IRA, and you are shielding roughly 7 to 8 times more income from taxes each year. For someone nearing retirement, this creates immense flexibility. If you have years where your side business thrives, you can maximize your contributions and dramatically lower your current income tax bracket. If you have a leaner year, there are no mandatory minimum contributions, you simply contribute what makes sense for your budget. Another common question is whether you can have a solo 401k if you already have a day job with a company 401k, or if you are already drawing Social Security or a pension. The answer is yes. However, keep in mind that the IRS employee elective deferral limit applies per person across all 401k plans. If you already maxed out employee deferrals at a corporate job, you cannot make additional employee deferrals into your solo 401k. If your spouse helps with the business, even doing administrative work, scheduling, or bookkeeping, you can pay them a fair market wage. Once they earn income from the business, they can also participate in the solo 401k. You also have choices regarding tax treatment. A solo 401k can be set up as a traditional pre-tax account, a Roth account, or a combination of both. Pre-tax contributions give you an immediate tax deduction today, which is ideal if you are currently in a high tax bracket and expect to drop into a lower bracket later in retirement. On the flip side, making Roth contributions means you pay tax on the money today, but every dollar of growth and every future withdrawal in retirement is completely tax-free. If you are ready to take action, the setup process is straightforward. First, establish or verify your self-employment status and apply for a free Employer Identification Number, or EIN, directly on the IRS website. While sole proprietors can sometimes use a Social Security number, brokerages generally require an EIN to open a solo 401k plan. Second, choose a provider. Decide whether you want a standard prototype plan from a low-cost major brokerage or a custom self-directed solo 401k trust if you plan to invest in non-traditional assets like real estate or private lending. For most people, a free standard brokerage account offering index funds, ETFs, and bonds is more than sufficient. Third, execute the plan agreement before the end of your tax year. To claim employee deferrals for a given tax year, the plan must be formally established by December 31st of that year. You then have until your tax filing deadline, including extensions, to finalize and deposit both your employee deferral and employer profit-sharing contributions. Finally, calculate your optimal contribution split with your CPA or tax advisor to ensure you maximize your tax savings without exceeding net income boundaries. Whether you are using self-employment to stay active, fund your dream retirement lifestyle, or smooth out the transition away from a 9-to-5, a solo 401k puts control back in your hands. It minimizes your tax burden, lets you build tax-free or tax-deferred growth, and lets you retain more of the wealth you work hard to create.